Hey, good morning, everyone. Welcome to another Thompson Hine coffee chat. Cheers. Today we're going to be talking about the mutual fund ETF share class exemptive application. As most of you probably know, that's been on file with the SEC some time. We expect it will be ordered fairly soon, and it should have a real big impact on the industry. Just a few words about me. I'm a partner at Thompson Hine in the DC office. Interestingly, at least I think, I started my career in the Division of Investment Management at the SEC and in the office that gives out exemptive applications. And when I was there, we did the first multi-class exemptive order for mutual funds, and we also did the first order that allowed the ETF to come into existence. So joining me today have Brett Eichenberger. Brett, do you want to say a few words about your background?
Yeah, thanks, Bib. Thanks for having me. Good morning, everyone. And since this is a coffee chat, thought I would mention what type of coffee I'm drinking today. So I'm drinking Smitten Dorless. It's a coffee I really like. It's from the Caribbean, and thought I'd share that with everybody. But little background on myself. I've been with the firm almost 20 years. Spent the entirety of that time working with investment companies, whether that's mutual funds, ETFs, closed-end funds, interval funds. Our firm, Kona Companies, the fourth largest auditor of registered funds in the country, working with around 1,900 registered funds. And on the ETF side specifically, we're second largest auditor of ETFs. So it's a topic and near and dear to our firms and personally talking about ETF share class. So thanks for having me today.
Thanks, Brett. To my left is Megan Clement. She's in the DC office as well. And Megan, do you want to say a few words about yourself?
Thanks, Bib. Good morning, everyone. I'm Megan Clement. I'm Senior Counsel in the Investment Management Group here at Thompson Hine. My practice focuses largely on registered funds, so open-end mutual funds and ETFs, as well as closed-end interval funds. And I advise my clients on a range of matters from fund formation and registration to reorganizations to day-to-day compliance and regulatory matters. And thank you all for being here today. We're really excited to talk about this topic with you.
Great, thanks, Megan. Just a couple of housekeeping items. You'll see in the bottom right corner, a chat box, so feel free to ask questions. The other thing is that this will be recorded and available, probably several days later after this session ends. So anyway, let's get started. And maybe I'll start with you, Brett. So Brett, what is the overall landscape right now of the registered fund industry, including kind of the convergence of ETFs and mutual funds?
Yeah, the landscape continues to evolve. We've seen, over the last 5 years plus, really the RA community has continued to adopt the ETF over other wrappers, including mutual funds. And really retail investors also have continued to gravitate towards ETFs. I think this is for a number of reasons. One, the ability to trade the ETF throughout the day. There's something about that full transparency, don't have to wait until 4 p.m. to either buy or sell the product, can trade throughout the entire trading day. There's obviously ease of access via multiple platforms for ETFs, so that continues to be a reason to gravitate towards those. And of course, the tax efficiency associated with ETFs is a large selling point for the product. The other thing we've seen in the landscape is mutual funds continuing to convert into ETFs. So that's something we've seen since 2021, probably well over 100 at this point of vehicles that have converted from the mutual fund to the ETF. But what you have associated with that is now all your investors have to open brokerage accounts. There's costs associated with the conversion, and not to mention that certain of the retirement platforms still really have not adopted the ETF structure. So it really depends on your client base whether you want to go that route. So we've seen obviously some groups be very successful in that, others not so much. But the other thing we continue to see is some of these legacy mutual fund shops either launch their own ETF products. So they might keep their existing mutual fund group and launch either clone products via an ETF structure, or we've also seen them go with other platforms such as like a white label platform or another type of ETF platform where they dip their toe into the ETF space and go that route as opposed to doing it within their own existing mutual fund trust. So that brings us to where we're at today. There's obviously a big push for ETF share class of a mutual fund, but also we are seeing applications for a mutual fund share class of an ETF. And you think about kind of what that means, it can be in some ways the best of both worlds. You could keep your existing product, your legacy mutual fund product, and launch an ETF share class and potentially reach a different distribution channel, among other things that we'll talk about a little bit later on.
Thanks, Brett. So when the SEC actually grants this order coming weeks, coming months, it's not going to be the first, it's not going to be to the first registered fund with dual classes. So it'll actually be the second. So what is kind of the regulatory history on this topic?
I can take that one.
Sure,
Viv, thanks. So in 2000, the SEC granted exemptive relief to Vanguard, permitting Vanguard to offer ETF share classes off of its mutual funds. And so for about 20 years or so, any other fund sponsor also wanting to offer a dual class structure, in addition to getting exemptive relief from the staff, also would need permission from Vanguard to use that structure, probably through a licensing agreement. However, in 2023, that patent expired, and so we've seen an uptick in fund sponsors applying with the SEC for exemptive relief to offer the dual structure. And it's important to note that in 2019, when the SEC adopted Rule 6011 under the 1940 Act, which would allow fund sponsors to offer ETF funds without applying for exemptive relief, it opted to not also permit the offering of an ETF share class on the basis that an ETF share class presents different policy concerns than Rule 6011 was intended to address. And so fund sponsors without having a rule to rely on, such as 6011, fund sponsors that want to offer the dual structure still need to apply for exemptive relief. Another point worth mentioning is that in March of this year, Dimensional Fund Advisors amended their exemptive application to incorporate a reporting structure and certain disclosure requirements that we assume were made in response to comments from the SEC on their application. And the reason why that's notable is prior to this, the staff often had indicated that it was not interested in approving these applications. And so we view that step as well, we are hopeful that that stuff indicates that the SEC is maybe taking a different view.
I thought I'd take a few minutes just to kind of explain the exemptive application process, because it's terminology people may not be really used to. What are you exempting from? What is the application? And one of the things interesting about the SEC and the 1940 Act is that Congress gave broad powers in the statute to the SEC. Specifically, there's a section 6C, and it effectively allows the SEC to override any statutory provision. And so, in this case, you have provisions in the 1940 Act that were designed to have a simple structure a single class, Section 18. There are also provisions to with respect to affiliated transactions, Section 17. So this mechanism allows the industry to file an application with the staff. It's an application that has to follow specific rules in the 40 Act on how you submit it, meaning you should just go and copy what somebody else did. So you make sure that you follow all the formality. And then when it comes into the SEC, it's reviewed, and then typically comments are given back, and then the fund complex would file for an amendment that addresses those comments. So it's a give and take. And then as you play it out, once the SEC is satisfied, then they are required under the Administrative Procedures Act to actually notice it in the Federal Register. And this allows the world, if you will, to object to the application, which is extremely rare. And then after a period, 25, 28 days, then it's officially ordered. And the only thing I'll add about this, there's been a lot of kind of press on this process and the dimensional application, but generally the SEC staff will pick one application when you have this kind of situation where there's a lot of different fund complexes interested, and they'll make that the so-called model application. And it's really kind of arbitrary which one they pick. And if you're an applicant and you want the same relief, they will request, and it's smart to do it anyway, that you track that application as much as possible, even semicolons when it should have been commas. I mean, and then you send a red line version in to the staff. And it'll be interesting to see how this plays out. The staff, I think there's well over 50, maybe 60 applications in now. They could reissue the order in bulk, so everybody gets it at the same time, or they could do it piecemeal. But the bottom line is there's been some reports about, oh, rush, get your application in. You don't want to be at the bottom of the pile. That's a little unrealistic. There's time to get your application in. And by the time you're able to kind of get everything on the operational side in place, you'll probably have your relief. So that's just a little background on that process. So Megan, let's go back to you. And I think the most important part of any exemptive applications are the conditions, and they're certainly important in the ETF mutual fund share class application.
Yeah, absolutely. I think the conditions tend to be the meat of the order. What we've been seeing is most of the applications contemplate about 9 or so conditions, and these include that a determination at the outset and on an ongoing basis that the dual class structure is in the best interest of the fund, and also each of the mutual fund share class and the ETF share class. To support that determination, there's another condition that the fund's advisor will provide reporting to the board on an initial and ongoing basis to help support the board in making that best interest determination. And this reporting will include information on cash flows, inflows and outflows for the mutual fund class, portfolio turnover, brokerage and other costs, the impact of performance resulting from having cash on hand to satisfy cash redemptions, and distribution of capital gains. The conditions also require that the advisor perform an ongoing monitoring of the dual class structure to determine whether the structure is creating any issues or any conflicts between the mutual fund and the ETF share class. Another condition that's really important is that another condition imposes certain disclosure steps on the fund to help avoid investor confusion. And these steps include, among others, having a separate prospectus for the mutual fund share class and for the ETF share class. And both of those prospectuses must disclose that the fund has received exemptive relief, and it must describe the dual class structure and risks associated with the structure. The ETF share class prospectus must disclose that ETF shares are traded on an exchange and are not individually redeemable. And ETF shares cannot be marketed as a mutual fund investment. So any marketing materials for an ETF share class cannot make reference to the mutual fund shares unless it's to compare and contrast the differences between an ETF share class and a mutual fund share class. So those are there are a few other conditions in there too, but I think those are sort of the top ones to think about.
Right, and it seemed like under the prior administration, the big hangup was cross subsidization, and generally that the mutual fund shareholders were benefiting more than the ETF shareholders. In that, in some way, looking at it from the ETF shareholders, some of the benefits of the favorable tax treatment, less brokerage costs, things like that would be somehow diluted with the mutual fund shareholders, and also the fact that mutual funds have to stand ready to redeem retail shareholders, which has traditionally caused them to hold more cash, causing a cash drag on performance. Just going a little bit off script, what do you make of some of those cross subsidization issues that were raised early on with these applications?
Yeah, I think those are good questions. It does segue into the kind of some of the operational challenges. So I think you do want to think about your expense allocation policy with respect to things like ETF transaction fees, or should those be pro rata amongst both classes if they're benefiting the mutual fund share class as well. Commissions on just buying and selling securities outside of the in-kind process, something to think about as well. Are those costs being, should those be borne by the mutual fund share class or the ETF share class? You got things like obviously class differences that we have now, 12E1 fees. That's not unusual to have one share class with a different expense structure than another share class. We have that today. And then you think about some of the things that generally ETFs have had, such as a unitary fee structure, whereas traditionally mutual funds don't have a unitary fee structure, meaning they just don't have one, management fee basis point expense. So if you are, opening up an ETF share class, maybe you just have that ETF share class, which is not unheard of, have the same expense structure as a mutual fund share class and put an expense cap in place, just like we see with the, multi-share class products today. So, I think those are all solvable kind of challenges when you think about, those cross subsidization kind of issues. You could argue also that, if you're utilizing the ETF share class structure to do rebalancing and things of that nature, that obviously benefits both classes. So I also think about this, Bib, from the perspective of, you have two different ways of looking at kind of these operational challenges. You have the investment advisor or sponsor, and then you have the service providers that provide services to the funds. So when you think about the sponsor perspective, I think, Megan, you brought it up about just the portfolio management changes here. You mentioned, cash drag. Well, you got to think about whether or not that's an issue now in a dual share class structure. When you think about how an ETF trades, it works with the capital markets to do rebalances of the portfolio, which is obviously different from how a mutual fund operates today, where the portfolio management team is doing those buying and selling trades, generally with, brokerage firms, which is a different structure. So potentially you don't have the cash drag in a combined product. Then you got to think about, again, does your product fit from a security selection perspective to be traded easily in the capital markets with a tight bid-ask spread. So you got to think about that from a ETF share class perspective. Then you think about some of the operational challenges of your service providers. Transfer agent for a mutual fund share class, you're going direct individuals coming in and out of the fund. Whereas on the transfer agency side of an ETF, you have creation units also going through your custodian. Does your custodian have the piping built to transact directly with the capital markets? So that's something you got to think about. And then you think about, does your portfolio management team, does your investment advisor have the piping built to transact directly with the capital markets from an in-kind perspective? We have seen a number of issuers that basically outsource that function to a trading firm that works directly with the capital markets piece. Then your portfolio management team is focusing on security selection, research, things of that nature, in building out the portfolio.
Yeah, and I think it's worth mentioning the board as well on a couple of levels. I mean, just picking up on that point, I know when the ETF industry was kind of springing into existence, and then the first mutual funds started offering their own ETFs, there was a high ramp up for the board to understand the nuances of ETFs, especially the capital markets, especially that you had a security trading live every day, and there could be an event. So if you're a mutual fund complex and you decide to add on an ETF class, then you need to go up that learning curve as well, because you're going to be hearing a lot at your board meetings about what kind of Brett was saying about capital markets. The spreads widening out, the lead market, just even getting all the jargon down, the lead market maker, that can be daunting for a period of time. And then I think secondly, with respect to the board, there's going to be a lot of owners put on the advisor to put them in a position to kind of police these issues. Some of them are hypothetical, but you look at the applications, you look at the early ones, they're talking about some kind of data analytics. So it's going to be really the SEC, in my view, and they've done this in the past, and it makes sense. They were struggling with a lot of these issues, and eventually kind of kicked it over to the board. And that's not surprising. So that means the board needs help, and the source is not only advisor, but service provider to lend them help. So one of the questions that we just came in, really it asks about the upsides and downsides of an ETF class or this structure versus just having a standalone mutual fund and a standalone ETF, including, obviously you mentioned a little before the tax efficiencies. And then there's also kind of related to that, the concern, okay, you're a mutual fund complex, you add this ETF class, and then nothing happens. Nobody's buying that. Do you want to tackle that first, Brett? Or
Yeah, I can start and you guys can fill in. I mean,
sure.
Yeah, ETFs are not bought, they're sold. A lot of people would tell you in the distribution world that's true. So if you think that you have a great mutual fund, it's got a great track record, open up an ETF share class and it's going to grow, that might not be the case. You got to think about your distribution plan. How are you going to get on additional platforms? Is there any conflicts of being on multiple platforms offering a mutual fund share class versus an ETF share class? So there are some things that really are exciting from a distribution perspective. You can reach a larger audience. Say you have a traditional mutual fund that has a lot of tax advantaged accounts, retirement accounts. This provides potentially a whole different distribution platform for you. So that's exciting. You mentioned the tax efficiency. I mean, the in-kind process, there's obviously benefits to that, but I think there's some challenges to that as well. You could be in a scenario where you have, if your ETF share class doesn't grow, Bib, and then you're just having to do a lot of transactions just within the mutual fund share class that has some turnover, you could potentially be in a situation where you generate capital gains. And then the capital gains not only get distributed, as you know, to the mutual fund share class, but it's pro rata to the fund as a whole. So the ETF shareholders would have capital gain distributions as well. So that's obviously, a concern. We talked about the expense allocation policy. I think some of the other, the other challenges are there's going to be additional costs associated with this. So you have one pool of assets, which is great, and you don't have to launch another product, but there are costs with launching an ETF share class. It's not, it's not zero. The other thing to think about is just, you mentioned it on the capital market side and getting, the terminology and understanding that space. That's going to be an important piece of your ETF being successful is, being able to provide a very liquid product with tight bid-ask spreads that, make it very attractive where you'd want the ETF share class versus the mutual fund share class. So I'll pause there and see if you guys have comments as well.
I mean, that Brett kind of covered the points that I was going to make. I was just going to sort of add with respect to adding an ETF share class. You have the advantage of the new share class being able to leverage the existing fund's performance record, and also its AUM that might get exposure to platforms sooner than a newly launched ETF fund that doesn't have a performance track record or has low AUM to start.
Yeah, and you mentioned platforms, and it's no secret that they have the leverage out there in the world, and they kind of dictate often what type of product they like to see, and especially more recently, fees have been important. And so in general, they don't like new and different. So we'll see how they react to this. I think in some of the, for example, the non-transparent or semi-transparent ETFs have struggled a bit with platforms. And we'll see if they have kind of that same reaction. Another thing is internally, you got to sell it to your portfolio management team because you have to post the portfolio every day. And, there are people, rightfully so, that believe there is a secret sauce sometimes to managing the portfolio, may not want to expose that portfolio, or, it does invite hedge funds and other market makers out there to follow your portfolio and potentially, day trade, if you will, and take advantages. So I think it would put a little bit more pressure on the trading. You're also, if you're a mutual fund complex, you're inviting body that people don't think of it as a regulatory body, which is the exchange. So they're listed. So if you ever try to look at their rules, they'll drive you crazy. They're not clear, and you can get a phone call from them anytime saying we stopped trading your ETF shares. So you really need to understand the whole exchange kind of regulatory scheme and their role. And then lastly, nobody should forget the chief compliance officer. This is going to add some more complexity to their job, and including, complying with the conditions of the exemptive order.
And Megan, what about, concerns on you could short an ETF, and then I guess you really can't close an ETF share class versus a traditional mutual fund where you can close, a fund if you believe your strategy only has limitations. I'd be curious your opinion on that.
Yeah, I mean, I think that sort of remains to be seen how you deal with that kind of situation. And I honestly, I don't know what the answer is. But that's a great point.
Yeah, I think it begs the question whether you can close the ETF share class or you have to continuously offer it. And obviously ETFs you can short. So some things to think about, I think, as we get towards approval.
Okay, well, thanks, Megan and Brett. I'll just remind everybody, again, this is being recorded. It will be available. I'm sure you're able to find any of the three of us. So if you had questions that didn't get answered or you have questions afterwards, by all means, feel free to reach out to any one of us. So thank you again for joining us today.
Thanks.
Thanks, everyone.